How to make your home a good investment. Wait, don't people say your home is your best investment? Now, for many people, their home may be their only major investment, but for them, that old conventional wisdom might be true. But that's unfortunate. It's easy to find better investments with dramatically higher long-term returns. Despite the lower returns, homeowners on average are wealthier for two non-investment reasons. So in this talk, you'll learn how do homes compare to other growth investments for rate of return? Why is it unfortunate if your home is your largest investment? What are the two non-investment reasons homeowners tend to be wealthier? Why does your home start being a great investment but then stop? Can your home be your retirement plan? Is home equity the key to wealth, or is it debt equity? And how can you make your home a good investment? All right, so first of all, how do homes compare to other growth investments for rate of return? So for many people, their home may be their only major investment. For them, that old conventional wisdom might be true, but that's unfortunate. The average home in Toronto has grown in value by 6.3% per year the last 50 years. That's more than most other cities in Canada. The central growth investment for long-term investing and retirement investing is the stock market, where returns have been dramatically higher. In fact, Toronto homes have grown in value only slightly more than GICs in that last 50 years. So the average home in Toronto beginning of 1975 was worth $52,806. Investing that amount until the end of 2024, so it's 50 years, here's how much you would have. So the home itself would be worth 1.1 million, just at 1,117,000. If you were in GICs, it'd be about 832,000, so you'd have 0.7 times as much. If you'd invest in the Toronto stock market, you'd have 7,242,000. That's 6.8 times more. If you were in US stocks, the S&P 500, you'd have 17,832,000. So you'd have 16.7 times as much. And in global stocks, in the MSCI World, you'd have 13,727,000. So 12.8 times as much. So you have dramatically higher rate of returns over the last 50 years. You get between 7 times in Canada, 17 in the US, and 13 globally, times as much as you would from having that same amount in your house. So it's huge, the difference. And I have a chart actually kind of showing it. It's quite dramatic. So now we value our homes for many emotional and non-investment reasons. A home provides stability, personal satisfaction, and pride of ownership. However, as a pure growth investment, our homes are not high growth. Now remember this stat. The Toronto stock market has had nearly 7 times the growth of Toronto real estate, and global US stocks returns are much higher than that. Now, why is it unfortunate if your home is your largest investment? If your home is your largest investment, you probably can't retire comfortably. Now, retirement planning has good and bad news. The bad news is that you probably need much more than you think to retire comfortably. The good news is that it can be much easier to get there than you think. We have written financial plans for thousands of Canadians. Everyone is unique. The total investments most need to retire with the lifestyle they want is between 2 million and 5 million. Now, some with very frugal retirements are less, some with very comfortable are far more, but that's kind of the average. Now, you can use the 4% rule as a general estimate just to fact check this. So a portfolio of 2 million sounds like a lot, but it supports a retirement of 80,000 per year before tax. So think of a couple each earning 40,000 a year. That's decent, but it's not comfortable. So I know it's odd thinking that 2 million is not a lot. So now if you're planning to retire in 20 or 30 years, the cost of living doubles about every 25 years. So to retire on 80,000 per year in 25 years, you'll need twice as much, or about 4 million at that time. Other than some in the FIRE community, financial independence means you become a multi-billionaire. A multi-millionaire is not rich today. In short, the average home in Toronto is a bit over $1 million, while most people need 2 to 5 million in investments to retire comfortably with the lifestyle they want. So it's unfortunate if your home is your most valuable. Now, what are the two non-investment reasons homeowners tend to be wealthier? So despite the lower returns than other investments, homeowners tend to be wealthier. There are two main non-investment reasons for this. So the first one is it's forced savings. It's a discipline. So homeowners are forced to make their mortgage payments, which means they slowly pay down their mortgage. They are forced to grow their equity. Tenants typically have significantly lower payments, but they're not forced to save the difference. Now, the other reason is leverage. So homeowners typically start with a down payment of 20% and borrow the other 80%. This means that for a $1 million home, they invested $200,000, but have an asset worth $1 million. Now, so basically they're leveraging 4 to 1. That's considered very high leverage. So in anything other than a home, their home is worth 5 times the money they invested. So the returns are 5 times higher. So for example, a leverage with a 20% down payment means that you have $1 million home, grows in value by a moderate 6% or 60,000, and you actually made 30% on the 200,000 you invested. A 30% per year return is awesome. So now, why does your home start being a great investment but then stop? So here's the ironic and actually quite funny part. Most homeowners spend their working lives focused on paying off their mortgage. They start with a 20% down payment and are making a return of about 30%. As they pay down their mortgage, their rate of return on the money they have invested goes down dramatically. Once they pay off their mortgage, their home value is growing only 6%. So if you compare this, so when they have 80%, when their mortgage is 80% of the home value, they're making 30%. When it's 60, they're making 15. If it's 50, they're making 12. If it's 25% of home value, they're making 8. And when the mortgage is paid off, they're making 6. So in short, your home starts as a great investment when you have a large mortgage. Then the return drops dramatically as you pay down your mortgage. Once it's paid off, your return is just moderate. Now, can your home be your retirement plan? I often hear people say that when they retire, they're going to downsize their home and use the savings for their retirement. There are 2 problems with that thinking. First, if you downsize in Toronto from a 2,500 square foot 4-bedroom house, to a 1,250 square foot bungalow or condo, so you have half the space, the prices may hardly be any lower. You likely won't clear very much. Remember that most people we see need $2.5 million to retire with the lifestyle they want. So to downsize, you have to leave Toronto and move to a much less expensive city. So second, the people that talk about downsizing are usually young. When you reach retirement, will you still want to downsize? Now, the vast majority of people we meet want to stay in their home when they retire. They're comfortable there. They have so much history. It's full of all their stuff. What do they do with all their stuff if they downsize? And downsizing usually would not get them much money. So now there is logic in selling your home to buy a rent, especially a condo. Freedom is the main thing. If you want to travel a lot, having a house is a problem. Who's going to maintain it, mow the lawn, shovel the snow? With a condo, you just lock the door and then travel as long as you want. Now, the investment logic of selling is that your mortgage is paid off, your home is not making a great return. Plus, it's giving you no monthly cash flow. If you have significant home equity, how can you use that to support your retirement cash flow? The easiest way is to sell your home and rent. You clear $1 million or more, invest it for more growth, and then withdraw a bit each month for cash flow. Selling a bit of your investments each month is called self-made dividends. I have a video talk specifically about that. This can help your retirement, but your home is likely not your retirement. Even if you sell it, rent, and invest all the proceeds, it's likely not enough. The amount you invest is probably less than the $2.5 million or $2.2 million to $5 million most people want to retire with the lifestyle they want. So is home equity the key to wealth, or is it debt equity? I hear both sides. For many people, the equity in their home is the bulk of their net worth, unfortunately. But many people call it debt equity. So what do you mean by debt equity? It can mean 2 things. First, that part of their net worth is not really getting stock market returns. And when they retire, the home equity generally doesn't give you any monthly cash flow. So the term debt equity is certainly exaggerated. It's not dead. It's still making a modest return, even if you have no mortgage. However, the main point is true. Your home equity does not support your financial freedom and retirement goal nearly as much as if you could invest it more effectively. And for 2, does not normally give you a regular monthly cash flow once you retire. So how can you make your home a good investment? Now, to keep your home as a good investment, you should keep a large mortgage on it for as long as you can. There are other considerations such as payments, but remember how your rate of return drops dramatically as you pay down your mortgage? There are two main ways to do this. Number one, pay off your mortgage as slowly as possible. So start with a 30-year amortization. If you refinance, try to revert back to a 30-year amortization. Keep your payment as low as possible and then invest the difference. With a minimum payment, your mortgage is likely to remain above 60% of your home value for many years. This means you can keep getting a return of 15% or more on the amount that you have invested. Most people that don't have a financial plan save far too little to become financially independent with the lifestyle they want. It's important to stay disciplined and invest all the savings from your lower payment. So remember, it's the discipline of a forced mortgage payment that helps homeowners be wealthier. A lower mortgage payment only helps you if you invest all the savings. And the number two way to make your home a good investment is the Smith maneuver. So this is an elegant strategy to keep reborrowing the principal portion of your mortgage payment from a linked credit line to invest. It converts your mortgage over time into a tax-deductible credit line. It can allow you to keep your total amount borrowed at 80% of the value of your home, or whatever level you are comfortable with. So now keeping your total amount borrowed near 80% of your home value means you can keep getting the 30% per year return on the amount you have invested in your home. So in short, a home with a large mortgage is usually a good investment. A paid off home is usually only a moderate return. Thanks for listening. Now, what we learned here is how do homes compare to other growth investments for rate of return? Why is it unfortunate if your home is your largest investment? What are the two non-investment reasons homeowners tend to be wealthier? Why does your home start being a great investment but then stop? Can your home be your retirement plan? Is home equity the key to wealth, or is it debt equity? How can you make your home a good investment? So thanks for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog for a full-service financial planner in Canada. It's just edrempel.com or unconventionalwisdom.ca because we're in Canada. So now if you're interested in potentially talking to us, we offer a free 30-minute consultation. Just go to edrempel.com/talk. That's just to see whether or not it's worth working together or whether it's a good idea. If you subscribe to my blog, podcast, and YouTube, all that means is you get my post every Thursday that it comes out. We don't market it in any other way. My podcast on all your favorite sites is on edrempel.com/listen, and YouTube channel is edrempel.com/watch. Thanks for listening, and we'll talk to you next week.